right, everybody. Good morning. It's 10 o'clock Central Time here in Texas, so we'll go to get started. I'm Mark Trice, Certified Kingdom Advisor, financial advisor, and founder of Clear Vista Financial. And this is our August market update, and glad you've taken a few moments to join us. So we're going to recap a few things about what happened in the month. As always, we're keeping a close eye on what's happening in the markets and the economy. I've even got some political commentary for those that love to enjoy politics or at least get their blood pressure raised or lowered by comments about politics. So we'll get started here. And we'll go over the market recap of July. We'll talk about some of the economic changes that took place in the month of July. And then we're going to talk about some of the impacts that we're going to see coming up. If you're a client, please note that in September, we will be doing a couple of client events to talk about some of the things that have happened in terms of tax policy with the One Big Beautiful Bill Act. Yes, that is the name of it. And we'll invite you to those things. We'll also do a webinar on those topics as well come September. We're still trying to figure all that out and trying to figure out what the implications will be. And as always, it takes the IRS sometimes years to get us the final rulings on how we're supposed to treat some of those things. So let's jump into the market recap of last month. As always, if you want to send a question in, and sometimes we're able to answer those live on the air, 254-282-0495. That is our text line. That is our business cell number. And use that number at all times. If you have my personal cell number, stop using it. We have compliance troubles when clients use my personal cell number. So this is 254-282-0495, or you can also send us an email at info@ClearVistaFinancial. We'll try to answer you on the program today or get back with you within a couple of hours here. So how did the indexes do? Well, things were generally positive in the month of July. We had a little bit of a sell-off here at the beginning of the month, and then we had a sell-off after the end of July. But overall, the S&P 500 was up 2.1%. The NASDAQ up 3.7%. The Russell 2000, which is a small caps, up 1.68%. Long-term treasuries were down again. I'll talk about that more in just a moment. And then the moderate index that we kind of compare, a lot of folks that are in the near or new to retirement phase or in that moderate category, if you will, that was up 0.3% for the month of July. So let's break this down just a little bit. I'm going to spend some time on this particular slide. Let's break this down a little bit. What we saw was more growth in the index due to the growth in the large cap stocks, the 4 or 5 stocks that have the largest market cap. Those 5 stocks are trading at 34 times their earnings. And that's really, really high, meaning that stocks are expensive. While the rest of the index, the median market cap was around 19 times earnings. Now, that's not as expensive, but here's what's interesting. What we're seeing is that top 5 companies, if you will, in the index, the largest market cap, their overall earnings for the quarter were right around 11.6%. That's exceeding expectations. While the rest of the markets of the S&P 500 components was really only expecting growth of maybe 2 to 3% for this last quarter. So whether you look at it in terms of market cap or the median or whatever, everything's expensive. And so it's really those top 5 companies that are raising the tide of all the indexes. So nothing to get really excited about there, but I do mention that because a lot of people are wondering why the difference between the NASDAQ and the moderate index when there's such a discrepancy there. Well, it's really 4 or 5 companies that are carrying all the weight. in this particular month for the month of July. NASDAQ, we saw some big moves amongst tech. That's some of the same components in the top 5 of the S&P. The Russell 2000 was up 1.68%, but that index is still down 10% from its all-time high back in 2021. So 4 years and some change, we still have not reached that pinnacle that we had back in 2021 with the Russell 2000 index. Same thing for long-term treasuries. I mean, the Russell 2000 at least is closing the gap, and we see continued strength in the small caps. I mean, we want to see that because that can indicate that there's more breadth to the growth in the markets. But the long-term treasuries, we ended a 40-year bull market in bonds a few years ago, and the longer-term treasuries just have not been able to recover because of interest rates going up so quickly and maintaining that level of interest rates for some time. We'll talk about the Fed and what their decisions were in just a moment, but long-term treasuries were down again for the month of July. So I just add that into context. It really didn't help me to show you different charts this time because we really didn't move much off of that. But the moderate index, one point I'll make out there, we made it back to our previous all-time high back in 2021 was the last time we hit that. We've touched it a few times, but it has not broken through. And we need to see that. We saw that happen with the S&P 500 this last month. Those are all positive things, but we still haven't seen that moderate index break through previous highs from 4 years ago. And primarily that's because of the drag that bonds are still having on that particular index. I'll throw up here our disclosures. Please read them carefully. These are just indexes. You cannot invest in them. If you want to learn how to mirror those things, you can give us a call. Okay, let's talk about this seasonality of volatility. I kind of joke with my staff that I don't like to take off work for a vacation or anything the first week of August because it always seems that there's an increased volatility at the end of the July going into August. And it's true, it happened this time around as well. We see this chart here that's showing the S&P 500, the seasonal volatility, what we typically expect. And throughout the month of July, all the way through really the end of October is when we see increased levels of volatility. So you're gonna see that this fall again, probably. So do not panic, do not make sharp, rash judgments, but you probably will see that. And we're going into that season of historically high volatility. All right, so the Fed met, Federal Reserve, and they all voted to, not all of them, they voted again to hold the federal overnight Fed funds rate steady. There were 2 officials, one of them being the Federal Reserve Chairman of Dallas, voted to cut those. You'll notice today in the news that the Bank of England cut their rates for the 5th time this year. The U.S. has not cut rates at all this year since the last cut they did in the fall of 2024. Jerome Powell, in his press statement and questions, basically said that it's too soon, and he doesn't want to move too quickly until the data validates those rate cuts. Now, here's the thing. The Fed is always going to be behind because they're always looking at lagging information and data. The Fed is getting a lot of pressure from the White House to cut rates. I don't like that type of intervention. I do think that Jerome Powell will be replaced when his term expires this next May. But I don't think there's any reason to fire him. He is doing what he's supposed to do there. There's not a lot of politics involved in this. Although with Trump, he wants to make it about politics. So the odds now of a cut in September with their September meeting or about 45% chance. And that next Fed meeting you see there is September 16th through the 17th. As always, we should really have an office party for our clients to come by on the 17th, so you can kind of gather and we can watch the Fed press briefing together. It's a lot of fun if you know how to break it apart and dissect it. So they acknowledge, okay, employment growth is slowing, but the good thing here is there is some disagreement. It wasn't a unanimous vote there to keep those rates where they were. So that tells me that we're going to see some rate cuts sometime this year. Just can't tell you how much and how quickly that will happen. Here's the U.S. Treasury yield curve. Remember that the short-term bonds are on the left-hand side. Longer-term bonds are on the right-hand side. We did have seen this invert this summer, and that's a more typical yield curve view that we like to see. We would like to see these shorter term bonds rates lower. We don't necessarily want to see the longer term rates go higher, as that impacts things like mortgages, car loans, and things of that nature. So let's jump into kind of a recap of the second quarter. Now, the headlines say economy grew 3% annualized in the second quarter. Yay. But that's not really that big of a deal. And I'll tell you why. It really seems like there was a lot of growth in the second quarter, but it's just basically a rebound from the tariff discussion and a lot of imports taking place in the first quarter. If you recall, the GDP growth in the first quarter was about minus 0.5. So there was no growth. Actually, the economy contracted, and that has to do with how imports are counted in the gross domestic product calculation. So it wasn't as big of an alarm as some people thought in the first quarter, because so many people were front loading their imports that they need to make with the uncertainty about what Trump was going to do with tariffs. We still don't know what Trump's going to do with tariffs. So that kind of skewed to the other side in this quarter to make the economy look a lot healthier than it really is. If you kind of average them out, you're really growing about 1.2%, that's kind of poor, okay? And that really is that tariff uncertainty, trying to figure out what's going to happen. And so they're starting to see some stress there with the growth of the economy. And despite this print here of the GDP growing at 3% annualized rate, the economy is cooling and beneath the surface. And so the Fed is going to be watching that a lot more closely now. And that's why I believe that with employment numbers, which we'll talk about in a second, and other things, that we'll likely see a rate cut here in September. We talked about GDP. We talked about the Fed holding the rate steady, interest rate steady. ADP payrolls came out before the government numbers, and they declared that payrolls were strong. They were actually rising faster than expected. And then 2 days later, the Bureau of Labor Statistics came out with their report showing that the number of jobs in the economy in the month of July grew at a very paltry, I think, $10,000 or $14,000. We'll talk about that more, 10,000 new jobs. We'll talk about that in just a moment. So pending home sales, they kind of fell off there. They were expecting that to grow just a little bit. It actually fell. That could be due to interest rates, less people being able to afford a home. And industrial production was flat. And so that's signifying a low investment of capital because people are uncertain about where the tariff situation is going to be going. We'll mention here for just a minute, I've got a couple of slides here on the One Big Beautiful Bill Act. Please do not text me and accuse me of being a big Trump champion. I'm very apolitical, if you will, and do want to look at things from an economic perspective. And my economic principles do not change based on who's in the White House. But This is what it's actually called, the One Big Beautiful Bill Act. It extended the 2017 tax cuts, which does help avoid a major tax hike. One thing that would have been certain, and we can't sit here and say that with certainty, if they didn't pass this bill, they would have done nothing. But this is what they passed. This is what's law. And we prevented the economy from certainly going into a tailspin if we had to have an additional $3 trillion in income tax increases for 2025 or 2026, excuse me. There are some pro-growth wins for small businesses and research and development. Those are good. It does add a few targeted, although albeit limited, tax breaks for tips, overtime, only up to certain levels of income, and then deduction of some auto loan interest. Now, these things will expire in the next few years, so they are not permanent. But those are things that were campaign promises, so those have been fulfilled. You can explain that or however you want, but that's what's in the bill now. They did do some cuts to spending increases. Now, this is important because some people are clamoring that Medicare's been cut and people are going to die. They did make cuts to the growth of the future plans of many government programs. Okay, it's very important. It's a distinction. It's not cuts in current spending levels. It is cuts in the expansion of spending for a number of different areas. Medicare was a big one. But even with all these different things, it's still going to add $5 trillion to our national debt over the next 10 years. No one cares about deficits and debt and things like that in Washington. It used to be you could count on at least one group being concerned about that, and now no one cares. And that should be a concern to us because at some point, it will become so onerous that the majority of government spending will be just to pay the interest on our debt, and that's not a good thing. So here's some things that were positive that came out of the OBBA and as it relates to retirement. One of them being the Roth conversions can continue, and we like that. And in fact, we'll be talking with our clients over the next several months, talking about how these conversion opportunities are actually expanded just a little bit. And but all this means is that doing proper tax planning is ever more important now with these changes in the law. And so when we want to talk to you about tax planning and things, we hope that you are able to help us out by helping us look at your tax returns from the previous year. We can do a little planning to help you predict what that might be for this year and help you avoid a lot of the potential gotchas that are out there still in the tax code to help you navigate this new bill. So we'll be talking about that. It's something you want to pay attention to. All right, so GDP grew. It did beat the forecast, but the boost, like I said, came from net exports, and imports were dropping a lot. And so this offset the numbers such that it made the GDP higher than expected. The core GDP, that's the consumer plus business plus housing. We don't really like to look at government spending in there, rose just 1.2%. And so that's something to pay attention to there. One thing, I hope the theme of this month's update is not so much, hey, everything's working or nothing's working. It's take everything with a grain of salt. Take everything with a grain of salt because it is far too early to be declaring a victory or defeat on either side. It is way too early to tell how the economy is going as a result of all these tariffs. The trade swing reflects the timing of the tariffs, and that's what we should remember there with that. So the core CPI rose just 0.2%, okay? And that was below forecast. The headline CPI held steady at 2.9%. All right, that's still a little above the Federal Reserve's target of 2%, but it's maintaining being steady. Shelter inflation, which had been one of the biggest, fastest rising costs, that slowed for a second straight month. So that's good. And the market is predicting a higher chance of a rate cut or multiple rate cuts by the Federal Reserve in Q4. Okay, so those are all some positive things, but things are holding steady. Producer Price Index, which is the components that go into manufacturing and things and production, that headline PPI was flat in June and July. And energy and food rose, but slightly over the last month or so. For the month of July, from the BLS, payrolls were up only 73,000 in the month of July. That was forecast to be at least 104, which is actually a low number for the month of July. And then there were further revisions for May and June that cut 185,000 jobs out of the reported results. So what did Trump do? Well, he didn't like the numbers, so he fired the director of the Bureau of Labor Statistics. I'm trained as an economist, and I've run survey research centers before. And believe me, it is very difficult. And I'm standing up here for the director of the BLS. It is very difficult to get people to participate. None of us are sitting around the house hoping that a survey researcher will call us. And the same thing is true when we're dealing with businesses. I mean, I get employment reports every once in a while. We're a smaller business, so we don't get them as often. But I don't want to have to spend time, replying to it and giving numbers out. I've got better things to do. I've got to serve clients. I've got to help manage their accounts. So it is very difficult to get accurate data that gets reported to the government. I kind of look at ADP's payroll reports and then the government payroll reports and look for something in between. That's probably a little bit more accurate. You've got two different sources and things here. But all in all, what it means is that the economy or payrolls are growing at a little bit slower rate than we or previous thought. Government is still one of the largest employers, and they're adding jobs the fastest. And although in July, government jobs actually shrank by 10,000 people, we expected that with some of the effects of DOGE and other things. Unemployment ticked up just a little bit, 4.2%, but amongst civilians. But as I've said before, 4% is considered full employment in a healthy economy. So the unemployment rate is not bad at all, unless, of course, you don't have a job and want a job, and then you're 100% unemployed. So that's a little mixed bag of data there. Housing starts, which is a kind of a leading indicator. It's the assumption by builders of what they anticipate demand is going to be. It's a little bit of a guessing game. We used to do a lot of research on this back in 20 years ago, trying to help builders forecast where they needed to build. Those housing starts rose 4.6% in the month of July. And majority of the growth came from multifamily, while single-family homes actually starts fell. Single-family starts fell 10% year over year. Multifamily, so this is your duplexes, fourplexes, and apartment buildings, were up 26.6%. That could be a reflection of the affordability of a mortgage for the average home in America, average household in America. Okay, let's see here. Existing home sales, those fell 2.7% in July. That is below forecast. The declines were mainly in the Northeast, Midwest, South, and only the western part of the United States saw gains there. So that's real important there. Let's talk about the impact of this. This is a lot of data, right? And it's often hard to decipher. Let's have a quick discussion of our strategy going forward. Number one, if you don't have a financial advisor, you need to talk to one. You don't need to be doing this alone. Surrounding yourself with wise counsel is always a good thing. Don't pay attention to the headlines. I'm going to talk here in just a minute about this. one side will come out and say that declare victory. Another one will start talking about children dying and things. And I'm being, overly exaggerating here to illustrate a point. When it comes to these tariffs impacting on the economy, it is far, far too early, too soon to be able to evaluate this properly. This is a moving goalpost and it's constantly changing. I don't know how the impact of these tariff negotiations are going to play out and what impact that's going to be because I don't like tariffs, number one. I believe tariffs are nothing more than a tax. Can they be useful in some ways when it comes to, say, national security or defense or things like that? Perhaps. But they are still a tax. And we're looking at this all in the lens of inflation and whether or not prices have gone up as a result of the tariffs. I think that may be one thing to look at, but we also have to look at other things as well. And calling this a tariff is nothing other than a tax. That will get passed on in two ways. All right. If there's an increased cost to a good that you buy because of the tariffs, and there's not replacement, sorry to get nerd out on you here, and I promise I'm not going to show any supply and demand curves on the screen, but that's going to get passed on two ways. Either the company is going to pass on the cost of that increased good because of the tariff, the tax, to the consumer, or they're going to absorb it, which results in lower corporate profits. Either way, none of those things are pro-growth. So yes, will there be result in more revenue coming into the treasury from these tariffs? Yeah, probably some. But is it going to get passed on in a way that's actually promoting economic growth in the United States? It is too early to tell. My assumption, my bias says that that's going to impact growth, but we don't know how, and we don't know for how long that will have a negative impact. So don't panic. If you are an avid news watcher, switch between Fox and CNN and just see what they're saying. The truth is probably somewhere in the middle because we tend to over-exaggerate things to both sides of the aisle. I try to block that out. I can only look at numbers and things, and I can't guess. I do not have a crystal ball to know what's going to happen with the stock market or the economy, but we're going to report on that, and we're going to be telling you information in a way that's not biased. And there's a lot of unanswered questions to me in my mind. So don't panic. Stay focused on your long-term goals. Investing is a long-term process. And please avoid decisions based on headlines. So it's important for you not to panic. Talk to your advisor. If you don't have an advisor, give us a call. You can call us for a free consultation. We're happy to do that. That's complimentary. We can help you understand your options, especially if you're getting close to retirement. We'll help you navigate those markets or at least put your fears at ease for that. And if you have a 401k at work, you've got lots of different options and tools that you probably don't even know are out there. And we're excited to talk to you about those things. There's things you can do within your plan. There's things that we can bring in to complement your plan to help you navigate those things. Because usually those 401ks are a little bit limited in their scope and what all they can offer you and stuff. So give us a call if you'd like to talk about that. And know that, as far as your financial plan, if you don't have one, everybody needs one. There's an old saying, I can't remember if it was Eisenhower or who that was, or perhaps somebody else. Could have been Socrates. I don't know. But if you fail to plan, you're planning to fail. And a lot of people are just kind of winging it going into important goals in their life. And that is not the way to go. You want a partner. You want some certainty as best you can. And the best thing you can do when you're developing a financial plan is you discover what you don't know. And that can help you answer those questions and determine what you need to know in order to have a good, comfortable retirement. So talk to a professional. Always check your statements. make sure things are behaving the way that you think. I would not be watching the indexes because that's not how most people invest. So, any questions or anything? I know I pontificated for a while. I hope we don't get texts saying that I'm supporting one candidate over another, but I will. And I've got canned responses for you because we see that a lot, and that's okay. We love talking with clients and visiting with you about your opinions and things, and we'll try to bring an unbiased approach to that to kind of look at both sides of the issue. I'm always, you never know what information and spin is going on out of Washington, D.C. You just don't know. I learned that very quickly when I was my time studying as an economist in the D.C. area and working with a lot of great economists up there and getting taught by a number of great people that taught me to be unbiased. But there's spin everywhere. And it's way too early for the White House to be putting spin that everything's positive. And it's way too early for other pundits to put negative spin on things because it's just too early. I'm reminded of a joke that was taught to me when I was a student years ago. And it was basically a mathematician, a statistician, and an economist were all interviewing for a job. They go into the interview, they first interview the mathematician, and the mathematician is asked, what's 2 plus 2? The mathematician says 4. And they said, are you sure? Yes, absolutely. 2 plus 2 is 4. Next, they brought in the statistician. Statistician was asked the same question, what's 2 plus 2? The statistician, being trained as a statistician, basically said, well, 2 plus 2 is more or less 4, plus or minus some type of variant that we can't control for. And so he was answering that question honestly like the mathematician, but from their own perspective. Finally, they brought in the economist, and they asked the economist, what's 2 plus 2? He looked around very sketchily, if you will, leans across the table to the interviewers and says, what do you want it to be? And this is what you have working in Washington, D.C. Spin, spin, spin. They will put a positive spin or a negative spin on anything that comes out. So as I said at the beginning of the broadcast, take everything with a grain of salt, talk to professionals and experts in this field to help you navigate these uncertain waters. And until next month, you've been listening to the Clear Vista Financial Monthly Market Update. Thanks for joining us, and we will see you next month. Have a great day.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.